All right, let's get right into it. We're looking at the latest hedge fund trend monitor from Goldman Sachs. And, on the surface, things look absolutely fantastic for these so-called smart money. But the title of their report, Not Out of the Woods Yet, well, that tells a very different story. It sets up this fascinating puzzle that we're going to solve together in this explainer. And that's the central mystery right there, isn't it? How can hedge funds be having such an amazing year, and yet one of the top investment banks in the world is basically flashing a giant warning sign? To really get why they're so cautious, we've got to look at the evidence piece by piece. Okay, first, the good news. And it is really good news. The average hedge fund, up a solid 8% so far this year. But the real headline is their VIP list. The stocks they love and own the most. That basket of stocks is up a massive 15%, just demolishing the S&P 500's 11% return. I mean, by all accounts, this should be a victory lap. But it's not. So, there's the puzzle. The numbers look incredible, but they're hiding something. It's time to play detective and follow the clues. Because here's the thing, not all returns are created equal. The way these funds made their money, that's the real story here. And our first clue is an event that sent absolute shockwaves through the market. Let's talk about the Great Short Squeeze. This is a massive piece of the puzzle. It was a violent, chaotic event that caught so many professional investors completely flat-footed. So, what in the world is a short squeeze? Well, to put it simply, it's when a stock that a ton of investors are betting against suddenly skyrockets in price. This forces all those short sellers to rush in and buy the stock just to cut their losses, which, you guessed it, only pushes the price even higher. It's this vicious, painful feedback loop for anyone caught on the wrong side. And this wasn't just any short squeeze. Goldman Sachs calls it one of the sharpest in the last 30 years. I mean, let that sink in. That's a huge statement. It tells you this wasn't some minor market tremor. This was a full-blown earthquake. And the scale here is just staggering. The group of the most heavily shorted stocks, the ones the smart money was sure were going to fail, spiked an incredible 30% in just 3 months. Can you imagine betting against a stock and watching it do that? It's an absolute portfolio killer. So the crucial point here is the fallout. This massive squeeze created total chaos. It forced funds to sell their winning stocks just to cover their losing short bets. This led to the highest rate of portfolio turnover or shuffling that we've seen since 2021. So funds weren't making calm, strategic moves. They were reacting. They were scrambling. And that is our first big flashing warning sign. Our next clue, let's call this one danger in the crowded room. And this really gets to the heart of why Goldman Sachs seems so nervous. I love this analogy because it just perfectly captures the risk. Think about it. If everyone on a boat rushes to one side to see a whale, what happens? The boat starts to tilt, right? It gets really unstable. A small wave can suddenly become a very big problem. Well, right now, that's the hedge fund world. And this isn't just a feeling. The data is screaming it. The crowding index is near an all-time high. Gross leverage, which is basically how much borrowed money funds are using to make bigger bets, is in the 95th percentile. That means it's almost as high as it's been in the last 5 years. And concentration, it's off the charts. The typical fund has 70% of its main portfolio in just 10 stocks. Everybody is on the same side of the boat, betting on the exact same few names. Okay, so this brings us to the climax of our investigation. This is where all these clues come together to reveal a deeply counterintuitive and frankly worrying trend: the popularity paradox. So which stocks are in this crowded room? Well, take a look. It's a who's who of big tech: Amazon, Microsoft, Meta, Nvidia, and Alphabet. These are the giants that pop up the most in the top holdings of hundreds of different funds. This is the crowded side of the boat. Now, for decades, there was a simple rule in the market. If a stock was a hedge fund favorite, that was like a stamp of approval. And if that popular stock reported great earnings, you could expect it to do great. The smart money was already in, and the good news would bring everyone else to the party. But that rule, it is completely, totally broken. This chart shows the paradox perfectly. For a decade, from 2005 to 2014, being popular was a tailwind. It helped the stock. But look at the most recent quarter. It's a significant headwind. Being popular now actually hurts a stock's performance after good news. Why? Think about it. Because everyone who might buy the stock is already in. There's no one left to push the price higher. And here it is, straight from the source. Goldman confirms this increasingly negative relationship. The very thing that used to signal future success, popularity among hedge funds, is now a predictor of underperformance, right when it should matter the most. This is a fundamental breakdown of a long-standing market strategy.
So what's the consequence of all this? Well, hedge funds are adapting. They have to. They're fleeing these crowded trades. We're seeing money rotate out of popular tech names like Google and into totally new areas, like cyclicals, companies that do well when the economy's strong, and financials. Capital One, for instance, saw the biggest jump in hedge fund ownership. The smart money is on the move, and it's desperately searching for a new playbook.
So let's bring it all home. We've seen the clues, from the violent short squeeze to the danger of the crowded room to this crazy popularity paradox. Now we can finally answer our big question and understand exactly why Goldman Sachs says hedge funds are not out of the woods yet.
So here's the verdict. It's crystal clear. Those great performance numbers are masking 3 huge hidden risks. 1. The threat of another short squeeze is still very, very real. 2. The extreme crowding means that if something goes wrong with one of those big VIP stocks, everyone is going to rush for a tiny exit door at the same time, and that causes a stampede. And 3. The core strategy of just piling into popular names is fundamentally broken.
And that solves our puzzle. The headline returns, they look great, but the engine underneath is sputtering. The market is unstable, the dominant strategy is failing, and everyone is positioned in a way that just magnifies risk. That is exactly why, despite the big numbers, they are very much not out of the woods yet. Which leaves us with this final thought. For years, investors have been told to follow the smart money. But with crowding at record highs and their go-to playbook completely falling apart, you really have to ask yourself, is that still a smart bet?